Okay, this presentation is about the different business structures. Now, I love this topic, not because it's especially interesting in and of itself, it's just different structures and how they use them. It's the concept of saving all of you from making horrible mistakes. Okay, this isn't one of those where you're going to say, because I decided to go with a corporation, I'm a billionaire today and thank you for that business structure. No, everyone's using one of these, but it is something where if you choose the wrong one, you could cost yourself, your family, your investors, your shareholders, your family members huge amounts of pain and suffering. So we're not going to do that. We're going to do it right. So let's talk about, here are the different structures. Sole proprietorship, partnership, corporation, also called a C Corp, C corporation, S corporation, and then limited liability company. We'll also be discussing a limited partnership, though only for a limited amount of time. So let's start out with the sole proprietorship. I'm not going to be reading these slides. I'm going to be telling you fairly quickly, but here's your visual. A lot of sole proprietorships in the U.S. These are easy to set up. It's very simple. You say, I'm now going to start doing business. I will name it John's Company, if you were me, and hey, you're in business. It's just about that easy. Okay, the government would love to have you do some paperwork and pay to have a license and things like that, depending on your municipality, but really that's about as simple as it is. Typically, more focused on services smaller than 50 people. Why? There's one owner, and that's it. Typically a limited scope. So the advantages, easy to put up, easy to keep it around. You don't have to share with other people. It's just very simple, basic, and done. Now, the disadvantages. We're not going to go past the first one, unlimited liability. I will explain that in great detail after the next type of structure, but we don't really have to worry about the other ones. That first one trumps them all and is the reason that you should never, in your careers, use a sole proprietorship. Moving on to partnerships. If you thought sole proprietorships were bad with that unlimited liability, this one is worse. So, in this one, we have at least two people are now in the company owning as owners. They're co-owning this business. They work together. They do all this kind of stuff. It has its own positives. Okay. Now, the thing that the partnerships and sole proprietorships have going for them: ease of management, easy to get in. Okay, they're easy to start, easy to keep going. There's not a lot of requirements there. And the taxation is simple. We call it flow-through taxation. Flow-through means that instead of, well, the way a corporation is done, this is the money from this is taxed just as your own personal income. Okay, when you're doing your taxes, you're going to do a Schedule C and say, I made this much money on a personal business. Now let me go through and put in the expenses, and we're done. Just yours. You'll realize how important that is when we get to corporations. But realize that's its main thing. It's called flow-through taxation. All right? Go straight through to your bottom line. No stopping. Now, typically larger than sole proprietorships, can be a little bit bigger, can be interesting. There are two different forms. General partnership, you're equal partners. Liability, management, everything is all the same. A limited partnership has a general partner, at least one, and then you have a limited partner. The difference, the limited part, is the liability. The general partner is completely liable, unlimited liability like a sole proprietorship. The limited partner gets limited liability, which means that he or she can only lose the amount of money that they invested in the company. Nothing else. So if this company is sued out of existence, they will lose what they put in. That's always up for grabs, but they're not coming after the assets of the limited partner. General partner, it's open season. Coming after you with everything they got. They're coming after your house, your 401k, everything they can grab. Okay? I'm not saying they can get your 401k, but they're going to come after you. All right? So, two types of partnerships. Advantages: easy to organize. A partnership agreement, absolutely necessary. You've got two people now. If you're talking about borrowing money, you have two people instead of one. That's helpful. It's still small, it's still flexible, it's still all those things. However, disadvantages. Look at our friend right here, unlimited liability. What does unlimited liability mean? Well, it means that if you start up a partnership, your best friend, and something happens, okay, I get hurt. I walk into your store, slip on water, fall, I get hurt, turns out that you are liable. I get to come after all of your assets and your friend's assets, everything. There's no, oh, but they can't take my house. Yes, I can. Unlimited liability. The business is you. No differentiation. So I can come after everything that you have. Okay? Because of that unlimited liability, I would not recommend using a partnership or a sole proprietorship in any way, shape, or form. Okay? It is a bad idea because in our world, people are suing people over everything. There's no way to say, oh, I won't be sued doing this. If you have experience with people, it's possible. You don't want them coming after your assets. There are better ways to do it. So don't do it. But for the sake of this class and the fact that a lot of people still use this, we have to know about them. So let's jump to the other extreme, shall we? And this is also kind of tracking along the history of businesses. There have always been sole proprietorships. Think of the farmer with 1 acre out there trying to make a living. Hey, sole proprietorship farmer. Partnership, 2 people in there. Corporations came about a little bit later, but still have been around for a long time, where you are creating a separate entity. This is its own, it's about the only way to say it, its own entity. It's like a person, but not human. Okay, a corporation can own and transfer property, can enter into contracts, can sue and be sued in court. It gets to act as its own being. It's like a robot created by the board of directors. Okay, this is good in some ways and bad in some ways, but it's a different animal. It's its own thing. So we're typically owned by a lot of individuals. Okay, we tend to think of these big corporations being owned by like the 2 big shareholders, like Microsoft. We say, oh yeah, Bill Gates' company. Well, no, there's likely thousands of shareholders. If you have a 401k, you might own part of Microsoft. Okay, so we do that by little shares of the business. We call it stock. And the way that, and this is a key, the way that an owner is paid the profits of a corporation is called a dividend. Okay. Now think back on our sole proprietorship and our partnership. How are you paid the profits of the company? Flow through, right? Goes straight to you. And done. Hey, we made a profit today. I'll take that money, put it straight in my pocket, and walk home. Pay taxes on it at the end of the year, no problem. With the corporation, the way you get paid is called a dividend. Keep that in mind as we keep moving. Now, some advantages. Great big one right here. Limited liability. What does that mean? It means that you have the same liability as that limited partner we talked about a minute ago. Meaning, yeah, if you've invested $100,000 into a corporation and the corporation goes under, you lose your $100,000. But they are not going to come after your house, not going to come after your car, not going to come after your savings account. The rest of your assets are protected. We like that a lot. Like, hugely love that. All right, ease of transfer of ownership. It's very easy to figure out the valuation of a corporation. Okay, you assign a price to each share of ownership and multiply it by how many shares you want to buy. Very easy. If you're a publicly traded company, you can do this by any number of online services. Okay, perpetual life. What happens to a sole proprietorship if the owner dies? Business is gone. It's gone. Same thing with a partnership. If you have one bad car accident, you're done. Corporation has its own lifetime. Okay, until you kill it, it lives. All right, securing funding is easier. You can both sell shares of stock in the public market or privately, or it's just easier to divvy up parts of the company and say, we'll give you this many shares of stock in exchange for money. And the corporation itself can get a credit rating. It's not just the CEO or the chairman of the board that's going to be run on the credit report. The company itself can get credit. Lots of expansion potential, huge expansion. Now, disadvantages. We're going to do the top one last. Owners and managers are not always the same and can have different goals. That's called agency problem, meaning the owners of the company might have one idea, the managers might have a different idea, and sometimes managing that discrepancy is difficult. Okay, it comes down to how you're going to motivate these people to do what you want them to do when the owners are not the ones actually managing, because you might have thousands of owners. Disclosure of information to the government and the public. Okay, this is Sarbanes-Oxley. Change this a little bit, but if you are a public corporation, you're going to have to publish your information, financial statements, Every year, every quarter, all the time, you're giving out all your information. They are expensive to form. This is when lawyers get involved typically. You have articles of incorporation, you have partnership agreements where you're going through and deciding exactly how all this is going to go. Very extensive, and often you need lawyers to figure all this out, especially if it's going to be big. Now, the last one, and the reason, the kind of the poison pill. Everything else you can kind of get used to. And you say, okay, we have to do this stuff, fine. It's big enough, it can expand enough, we can get the funding, we're okay. Double taxation is a poison pill because what this means is that the corporation makes money. You have to remember that you as the owner do not make money. It's not like a partnership or a sole proprietorship where you're saying, I went out and made money today. No, the corporation did. So if you go to the end of the year, for example, and you have $1 million in net income, okay, $1 million that the company made this year, you can't just go write yourself a check. It doesn't work quite like that. Instead, you have to go to the board of directors and say, let's issue a dividend of $1 million, please. They, if they're doing what you tell them to, which hopefully the majority stockholder, they're going to say, okay, and they're going to cut a check for $1 million distributed to all of the stockholders based on percentage of ownership. So let's say you have this $1 million now. Do you think that the government is going to turn a blind eye to that and say, oh, the corporation already made that money and paid its taxes? That happened before net income. So that money that they gave out to the owners, that's just free. Yeah, no. Instead, that is taxed by capital gains tax. A dividend is another taxable entity. So what that means is that that money that was made by the corporation was taxed once at the corporation and again if you take it out of the company. Double taxation. Okay. If you made the same amount of money with a partnership and with a corporation, you will have less of it in your pocket with a corporation than with a partnership. Okay. That's a bitter pill to swallow, though sometimes this expansion potential makes it okay. Now, some other ones, I'm not going to mention joint ventures, that's a whole different conversation. An S corporation. It is a corporation. Think of this as a middle ground. It is a corporation, but it's taxed as if it were a partnership. So we take the double taxation out. We like that. However, it does limit the number of shareholders that you can have. Okay, so it's kind of unwieldy. It's nice, but it doesn't quite meet all of our entrepreneurial needs. The one that we do want to look at is this limited liability company right here. All right, this one is basically shaped like a partnership, but you can have unlimited numbers of members. We call them members, not shareholders. But limited liability, just like a corporation, flow through taxation, just like a partnership, and it's easy to keep up and running. One of the things, talking about ease of keeping it up and running, a corporation, you have to have annual board meetings. Guess what happens if you don't have those meetings? Well, then if you're sued, a good lawyer is going to say, you're no longer a corporation, you're actually a partnership and we can come after your assets. Things like that are what make a corporation hard to deal with and what make a limited liability company nice. So, last word on the subject, not exactly, but kind of. If you're going to start a business, do not start a partnership or sole proprietorship. Start a limited liability company, an LLC. Okay. Depending on your state, you can do this in, the last time I did it, took me about 2 hours on the computer and 24 hours for them to clear the name. And that's about it. Okay. It's a very easy way to do it, and you have a lot of the positives. Now, going back up to where we started. Here you are. Sole proprietorship, partnership, corporation, S Corp, LLC. One owner here, two owners there. Unlimited, S Corp up to 75. Limited liability, unlimited number of members. This slide is wrong. It says shareholders, it's members. Taxation, flow through, flow through, flow through, flow through, double tax. Liability, unlimited, somewhat limited only if you have a limited partnership, but then these three are limited. The different uses, yeah, that kind of summarizes a little bit too much. There are your different ways of doing things, plus a limited partnership. If you're starting a company, go with limited liability company. Next question is always, well, what if I want to become a corporation? You can. You can move from any of these to any of them. Sometimes a little bit more difficult. You might have lawyers and or accountants in the mix, but you can. Safe bet, start here, move into a corporation when you need to expand. Okay, hope this was helpful. use it on your assignments and things like that. And thank you for watching.